Second part of the question is that obviously with preferred issue, you have a situation where the common shareholder moves to the back of the line, as it were. Why should the common shareholder in this room want to step to the back of the line if he's at the front of the line now?
Well, but it's also true if we buy a business for cash and let's say we borrow the money, the bank that we borrow the money from will come ahead of the common shareholder. There's no question. Anytime you engage in transactions that involve the capital structure, potential for each part of the capital structure. If you issue a lot of common and you've got some debt outstanding, you've generally improved the position of the debt. And the question really becomes whether you think that the position of the common shareholder is improved by issuing either preferred stock or perhaps borrowing a lot of money to make an acquisition. I mean, a couple of times in the history of Berkshire, we've borrowed money to buy something, to buy a business. And when we do that, we are placing a bank or an insurance company or whomever ahead of the position of the common shareholder. We did that when we issued some debt a few years back. And there's a question of weighing whether the common shareholders are going to be better off by borrowing money. But borrowing money is not necessarily at all harmful to shareholders, although certainly if it's carried to excess it is. And the preferred is a form of quasi borrowed money that does rank ahead of the common shareholder. But then at the same time, we're adding a business which we think is going to benefit the shareholder if we issue that. So that's the trade-off. Yeah.
My name is Matt Zuckerman. I'm from Miami, Florida. My question is, it seems to me that there's some requirement for shareholder votes if convertible stock, preferred stock is issued beyond a certain limit. What are those limits?
There are no limits on the conversion term that we might do. But, for example, if we were going to issue a convertible preferred now, we have no plans to do it, but it could happen. In fact, it might well happen this year. We would, and the alternative, we'll say, was giving somebody $100 million in cash for a business. If we were to issue a straight preferred, we would figure out what $100 million worth of a straight preferred would sell for, what coupon would be necessary. And that would depend on call provisions and a few things. But for a AAA credit like Berkshire, it would be somewhere in the area of 7% or thereabouts. And then they would have no participation in the upside of the common. If they wanted something that was sure to maintain its principal value, then you have to issue an adjustable rate preferred that will keep its value around par. That preferred might have an initial coupon of, say, 5% or something of the sort because it has the ability to go up or down based on interest rates, but it would always be worth about par. If we were to issue a convertible preferred, it might have a conversion price of, just to pick a figure, $28,000 or something of the sort, and a coupon well below the coupon on a straight preferred. And so whatever we did, they would equate out in our mind as to the value we were giving. We're not going to give 120% of X if we're only willing to pay 100% of X just because the form of a deal changes. But you may well see us issue at some point. You may see us issue a convertible preferred. You may see us issue a straight preferred. You may see us issue an adjustable rate preferred. I hope we do something because I'd like, if we do it, we'll think we're better off.